Good afternoon, everybody. It's Tuesday, January 31st, 2023. I can't believe the month's over already. Jason Isaac here, lead PM for the NCM Global Income with Growth. Just with a quick update for you. I'm just looking at my Bloomberg now. We've been drastically climbing the wall of worry this month. It's actually been a very, very good month after a troubling 2022. Some things that I'd like you to know. We're very, very, very close to a bullish breakout. And as many of you know, if you've listened to some of my presentations, it's pretty simple, 50-day moving average, 200-day moving average. We're about breaking over that, otherwise known as the Golden Cross. Since 1957, we've done some stats. If you went long and bought stocks or indexes on the 50-day moving average, when the 50-day moving average is higher than the 200-day moving average and done nothing else, your average annualized return has been 15.7%. If you did the same strategy when the 50-day moving average was under the 200-day moving average, your average return was positive 4.4. So this bleeds into the asset mix call. When we're above the 50-day moving average, you want to be long equities. When you're below, you want to be short. Also, Europe's breaking out, which seems absolutely hard to believe considering they've got a war, the largest continental war in Europe since World War II. And the GIG, the Global Income with Growth, has been participating in that. Credit quality, credit spreads, US dollars, cyclicals outperforming defensives, and in the growth and inflation combo is all positive for the markets. And then when you bleed into some GIC sectors, industrials and consumer discretionary are really starting to get a bid, and they're doing extremely well. But, and there's always a but, volatility has a seasonality. And what do I mean by that? Typically, high risk, high beta, high volatile names do typically very, very well in January. January tends to be a revision month, meaning anything that didn't do well last year tends to do really well in January. So you're seeing a lot of short covering. You're seeing a lot of high beta names. You're seeing names that absolutely took it in the teeth over 2020 performing extremely well this month. But conversely, February and March are ugly months for volatility. There tends to be a revision there, and that yield curves are still negative. So there's always something good, something bad. It's never too hot. It's never too cold. So with that, with the GIG, what we're doing is we're playing a very aggressive defensive game. What do I mean by that? Well, we're 2% cash. We're about 14% fixed income, and that fixed income's a low duration exposure and with very high credit quality. We've gone up the ladder with the credit quality. We're about 84% equities, so it's very aggressive in positioning, but we got a low beta lean with a very high dividend growth exposure. And then in the sector positionings that I'm expecting for 2023, I'm favoring discretionary, healthcare, energy and industrials, and non-North American assets. Global equity managers across the globe are very, very underweight developed markets that are not in North America. So that means Europe and Japan specifically. So there's looking like there's a lot of opportunities there. And with that, I just want to wish everybody a good day, and we will talk to you soon. Bye-bye.